Hello, everybody. Welcome to Collect Investments. Today, let's discuss options. So what is options? Option is a contract that give you an option to exercise, which means you buy or sell 100 shares of the underlying equity, which could be stock index or stock itself, or even futures. And then you can buy and sell at the strike price of the expiration date. So there are two types of options. One is called call, give you a right to buy. The other is put, give you a right to sell. So just show you a quick example. So assume the SPX price on February 23rd is 4,117. And then if you think SPX will go up in about a month, so you find a call with a strike price of 4,200, expires about a month later, and the price of the call is $60. Because one option contract is for 100 shares, so in order to buy this call, you need to pay $6,000 plus commission, depending on your broker. And then if the SPX is higher than the break-even point, which is the strike price plus the money you have paid, which is 4,260 on the expiration date, then you have a profit. But actually, on that day, SPX dropped. So all your investment, basically $6,000 per contract, are lost. You lose 100% on the call. So this is common. If you buy option, the stock has to move for your direction at a large amount before you can make a profit. A common way to look at the options profit and loss is to use a risk graph. And Option Creator is a website that shows you the risk graph of different options. So for example, this is a screenshot from that website, and I'm buying out of the money long call. The x-axis is the price of the stock, and the y-axis is your profit and loss. So I'm assuming the stock price is 100. The blue line shows if stock goes up, the call option also worth more money, and it goes down, then you're losing money, but you only lose at most the call option you paid. So there are two lines, the blue line and the orange line. The orange line means the price of your option and the expiration date. So if the stock stays at 100, the blue line will keeps dropping until it becomes the orange line. So it loses value if stock stays the same as before. So you can play with it by doing the options to find out the properties of different stock options. So there are some common option terminologies. The important ones are the relationship between the strike price and the stock price. In the money means for the call, the stock price is bigger than the strike price. So basically, if you look at the picture on the right, this is the call option with the strike price and here. If the stock price is higher than strike price, it's a in-the-money call. And for the in-the-money call, it has some intrinsic value where after the option expires, the call still worth some money even if the stock price doesn't change. So in-the-money options are more expensive. And at the money means the strike price and the stock price are the same. For out of the money, it's the opposite, where your stock price is here for the call and the strike is higher than the stock price. Or for put options, if your stock price is around here and your strike price of the put is lower than the stock price. So out of money options, the stock price has to move buy a large amount before it can make money. But you also need to consider how fast it moves. If it doesn't move fast enough, you may lose all of the money. The upside of OTM options are that they are much cheaper than the in-the-money option. And there are also two exercise styles you need to pay attention to. One is called the American style, which means you can exercise your option at any time on or before the expiration date. And all the stock options are American style. If you short option, basically you sell options, your options, when they are deep in the money, there is a risk to be exercised. So your short option could become a bunch of stocks. So if you sell call, you may end up shorting stocks. Or if you sell put, you may end up owning or longing the stocks after it's assigned. So you need to consider the assignment risk. There's a probability if the option is deep in the money, it could be assigned. It often involves dividend and many other factors. And there's also the European style options, which means they have to exercise on the close of the expiration date, but not earlier. And those are the index options. So if you buy and sell S&P 500 index option, that's European style. You cannot do early exercise. It's also cash settled, which means the price of the option turned into cash. It deposited or withdrawn from your account, depend on the value of the option. And you don't end up owning the index, but you own cash. And there's a mark-to-market rule for the European style option. So for example, if you hold the option that expire next year, at the end of this year, the price of the option will be used for your income tax purpose. So even if you don't sell it or you don't close a position, it still generates income tax or capital loss if you are losing money. And the European style options are also called Section 1256 contracts, which gets 60-40% tax treatment, which means it always have 60% long-term capital gain or capital loss and 40% short-term capital gain or capital loss. Even if you hold the option just for a few minutes, you still get this tax treatment. Or if you have a long-term option, which exercise or expire more than a year, when it happens, you still get 60% or 40% long-term, short-term capital gain loss. And actually it happens at the end of the year already based on the mark-to-market rule. So for the European style, because of the mark-to-market rule, there is no wash sale rule, which means you can buy and sell. When you report tax, you don't need to consider the wash rule. But for American style option, it's treated like stocks. So you have to consider the wash sale, which is quite complicated. Another basic about option is called synthetics, which shows the relationship between different options and stocks. So let's use S means long stock and minus S means short stock. And similarly, C and minus C, P and minus P. So we have the following conditions. Stock equal to you long call and you short put. So long call plus short put is also called synthetic stock. And in this relationship, you can do simple arithmetic calculation. Then you can get that call becomes put plus stock. So if you own stock, you can buy some put. Then it's equivalent to a call. This is called synthetic call. Or if you have call and then you short stock, you get synthetic put. Similarly, if you reverse the sign of all the formulas, you could get synthetic short stock. So you have put minus call, synthetic short stock. You can also get synthetic short call, synthetic short put. So this means for S minus C, if you already have long stock and you sell call on top of it, what is it? This is called covered call, which is a very common strategy that I see many people use. And S minus C. If you look at this formula, the synthetic put formula, you know that it's equivalent to minus P or short put, also called naked put. So from the name, it doesn't sound like a good strategy. And the next time, let's analyze what is covered call and why I recommend not do it. Okay, that's all for today. Thank you.